to this month's financial planning update for November 2021. We begin, as we usually do, with an update on markets, and of course it's been a very interesting time just over the last few days as we've had the emergence of the new Omicron variant of COVID. You can see that reflected right on the very far right hand side of the charts here. And we had a pretty significant fall in markets on Friday last week in response to the Omicron news, and specifically in response to restrictions being reimposed by governments across the world. The major sort of casualties of that market fall were the obvious suspects at this stage, really, airlines, travel companies, and hospitality businesses, who of course tend to be more severely affected by these sorts of restrictions being reimposed. Notice that the position with the UK market was somewhat worse than the global and the US market. And once again, that's reflective of the UK market being home to far more of those businesses that are affected heavily by restrictions, things like airlines and hospitality businesses. Now, although those businesses, of course, feature in the US stock market, they make up a much smaller proportion of the total value. And we all know that the US market is now dominated by the big technology stocks. And frankly, they're the beneficiaries, generally speaking, of these restrictions and potential lockdowns in the future. So we can see the damage was far less on the US market than it was in the UK. Now that puts us in a position where the US has really motored ahead. If we track back to October, there wasn't actually too much difference, that the markets were sort of starting to converge to a certain extent. But notice what's happened since the end of October, that the US has really taken off, whereas the UK market has been relatively flat during that period. Now, don't get me wrong, the UK has still posted a nearly 14% return year to date, even accounting for the drop that we saw at the end of last week. And I think, frankly, had that been offered to us on the 1st of January this year, most of us probably would have taken it. But the fact remains that the US market continues to storm ahead. In terms of how that translates into portfolio performance, we see here the portfolios behaving very, very much as expected. And it's a really great example of how the different risk profiles behave under market stress. So once again, if you turn your attention to the right-hand side of the charts here, you'll notice the adventurous portfolio has a fairly significant fall, whereas on the cautious portfolio, the drop barely registers on the chart. And again, that's exactly how we would expect the portfolios to behave. Even accounting for the drop, and it's worth mentioning much of that loss has now been recouped over the last couple of days. We see the balanced portfolio still having delivered 8.5% return year to date, which is very much on target, and the adventurous portfolio in excess of 12%. So once again, very sensible figures. We've recently made some changes within most of the portfolios. We are starting now to increase our global equity exposure. We've also added a very tiny amount of UK government bonds back into the portfolios, having been absent for many, many years now, because the yields on those bonds are starting to look at least somewhat more attractive in relative terms. But I do stress that that's still a very, very tiny part of the overall portfolio, and we're still very much underweight on UK government bonds. Finally, as far as the markets are concerned, we do our usual comparison of the active and passive portfolios. Passive marginally ahead at the moment, although that's a reversal of the situation from a couple of months ago. If we look at the active portfolio, we can see that that did pull ahead sort of September, October time. Although, again, both of them performing very much in line with one another in recent months. There will also be the new sustainable portfolios to add to this chart next year. So we'll start reporting on those, and it'll be very interesting to see how they behave in contrast to the other more mainstream portfolios. So watch this space for an update on that one next year. Finally, just to continue a slide that I've had for a few months now, just keeping an eye on inflation. Inflation once again has been rising over the last month, so we now see CPI inflation at around 4%, RPI inflation now over 5.5% if we look at this on a rolling 12-month basis. I think it's fair to say the inflation we're seeing is now somewhat more entrenched, that there was some suggestion when inflation started to spike that this would simply be a transition away from the pandemic world of last year. But given what's going on in supply chains, very well publicised shortages of various raw materials around the world, I think it's fair to say that this inflation is a bit more stubborn now. And it appears almost inevitable that the Bank of England will increase interest rates next month. The only caveat to that, of course, is the Omicron COVID variant, and that may give them pause for thought, possibly. So it'll be very interesting to look at the minutes from the December meeting of the Bank of England and see what they've got to say. But the Omicron variant could be the only thing, perhaps, that prevents them from increasing interest rates. Now, finally, we mentioned this last month, and there's actually been a huge response, a huge interest from clients in hearing some more about advanced financial planning ideas and concepts. Now, this first concept, called a VCT Ladder, we presented to our client advisory board a few months ago, and that the feedback was incredibly positive. And I had several emails after the day we spent with our advisory board saying, can you do more of this, some more of this creative planning? So we've decided to try and include one of these more advanced ideas at the end of each of our monthly updates. Now, to stress, these ideas are most certainly not going to be right for everybody. These are ideas that suit different types of people, and they tend to be fairly niche concepts that are going to apply maybe to 5 or 10% of the overall clients that we work with. But we're going to present a whole variety of different ideas in the coming months, and potentially there'll be something in there that might be suitable for you. So we're looking today at a VCT ladder. So these can be very effective for those people in retirement who have some degree of income tax liability that we're looking to manage over time. Now, a VCT ladder, you can of course set these up during your working life as well, but we've had a lot of clients who have just entered retirement who are looking at a VCT ladder as a way to mitigate income tax liabilities. Now, these work especially well if set up in the early years of retirement because we get a compounding effect over several years. And for the purposes of this case study, we're going to imagine we have a client here who's just retired and they've just taken a £250,000 tax-free lump sum out of their pension, and we're assuming that they have other liquid funds available in ISAs and share portfolios perhaps. And they have an approximate income tax liability of £9,000 per annum, which is due from their final salary, pension and rental income. So the way a VCT works is when you make an initial investment in a VCT, you receive a 30% income tax refund. So our assumption here is this particular client invests £30,000 per year into a VCT, and that generates a £9,000 income tax refund. So in effect, we're completely offsetting the tax liability of this particular client. Now, we repeat that process in year 2, 3, 4 and 5, and each year we fully offset the income tax that was due during that particular year. So over a 5-year window, we've invested £150,000 and we've received £45,000 back in tax relief. Now, where the VCT ladder concept kicks in is that once you've held a VCT for 5 years, the income tax refund is then effectively locked in. And if you wish, you can encash the VCT in year 1 and you can invest it into an alternative VCT. And on the same money, you can claim a further 30% income tax refund. So in this example, the £30,000 we invested in year 1, let's imagine we invested it into VCT-A. In year 6, we then cash that money in and we invest it into VCT-B, and that generates a further £9,000 worth of income tax refund. The year 2 money we can cash in and reinvest in year 7, and so on and so on and so forth. So the reason we mention this as a concept to use in retirement is that if it's done early in retirement, you can make those investments for those initial 5 years and then potentially continue to offset your income tax liability for many, many, many years or decades in the future. Now, of course, this concept can be useful for people who are employed as well. We have several clients who use a VCT ladder as an alternative to a pension. perhaps those clients that have exhausted their lifetime allowance, or they're suffering from the tapered annual allowance because they've got very high earnings. So ultimately, this is a concept that can be used during a working life, but also very effective in the early years of retirement as well. Now, I do stress that that is a sophisticated investment vehicle, most certainly will not be suitable for everybody. And of course, if you would like to know more about that and how it might relate to your own situation, please do get in touch and we can give you some specific advice. That's everything for this month's update. Of course, next month is December, so the update will come to you probably in early January. So I'll take this opportunity to wish everybody a wonderful Christmas and a very happy New Year. And we look forward to providing further updates in 2022.